So if you've been looking into Roth IRAs, you might have heard that the contribution limit is $6,000 per year in 2022. However, that's actually not the case, and in this video, I'm going to be showing you exactly how to contribute over 10x that amount into your Roth IRA every single year. And the best part is it's 100% by the books and actually written into IRS code, so you don't have to worry about this being in any kind of legal gray area. But that being said, I do want to mention that I am not a tax advisor. This is just what I personally do. So do not take this as advice and just take this as a documentation of what I personally do with my money. Now, there's a 6-step process for how this all works. So let's dive right in and start off with step number 1, which is to make money. Now, this might seem self-explanatory, but this strategy only allows you to contribute earned income into your Roth IRA. So in order to maximize this strategy and put a full $67,000 into your account, you'll need to have at least that much in after-tax income coming in this year. Now, I say after-tax income because with funds that you're putting into a Roth account, you've already paid taxes on those. So depending on where you live in your individual circumstances, this will probably translate into about $90,000 or so in pre-tax income. So if your boss is cutting you, say, a salary of $90,000 per year, that's approximately what it'll take to make this strategy work. Might be a little bit more or a little bit less depending on your individual circumstances. Now, if you make less than that amount, which most people do, you're still going to be able to use this strategy. They'll just be limited by whatever your after-tax income happens to be. Which brings us to step 2, which involves a little bit of 401k magic. So now that you have the money, we can actually get started on this strategy. And at a high level, let me just explain what you're actually going to be doing here. So basically what we're doing is we're taking money, we're contributing it to a 401k, and then we're rolling that money from the 401k into your Roth IRA. The reason we're doing this is because 401ks have much higher contribution limits than Roth IRAs do, like we said before. With a Roth IRA directly, you're only able to put $6,000 per year into that account if you're even eligible for one. But with a 401k, the limit for contributions in 2022 is actually $61,000. And so that's where we're getting the $67,000 into your Roth by leveraging this 401k. But it's not just as simple as putting money into the account. There's a lot of hoops we got to jump through, which we're going to be covering throughout this video to make sure you know exactly what's going on here. Because if you just go to your boss and say, hey, put 61 grand into my 401k, it's not going to work out for you. Okay, so pay attention as we go through exactly how this works, but that's high level what's going to be going on here. Now, the first complication you might run into is that your 401k does not have the necessary provisions. And I'm going to cover what those are in a second, but just be aware that not all 401ks are going to be able to do this. Now, you can do this strategy both as a self-employed person, which I am, or employed at a company. The easier thing about being self-employed is you can create your own 401k plan, which is what I have done, to make sure that those provisions are in there. Now, if you're at a big company, it's not guaranteed that those provisions are going to be in there, but it's going to be much more likely if you're at say, a large tech company where a lot of people are making a lot of money, that they're going to have a more gracious 401k plan written up than if you're just working at, say, a mom and pop shop or a restaurant. It's a lot less likely that you'll have this strategy written into your plan. So that being said, let's dive into the 2 provisions that your plan actually needs in order to run this strategy. The first of which is the ability to make after-tax contributions to your plan. This kind of covers the putting money in step of the process. We're putting money into the 401k and then we're taking it out and putting it into the Roth IRA. So to put the money in, you have to be able to make after-tax contributions. These are different from Roth contributions. Now, there are really 3 types of funds that you can contribute to a 401k. Let's cover those just very, very quickly. First, you've got your pre-tax. Okay, these are the normal kind of 401k contributions you probably think about, where you put money in, you get the tax deduction today, and then in retirement, you have to pay taxes on those funds as you distribute them. Okay, that's pretty self-explanatory. Next bucket we have is the Roth bucket. Okay, so if you're putting Roth funds in, you're paying taxes on them today, but then in retirement, you're taking those out tax-free. Now, the third bucket is the after-tax bucket, and this doesn't really have the benefits of a Roth where you're getting a tax benefit in the future, nor does it have the benefit of pre-tax funds where you're getting the tax deduction today. So basically, you're getting a worse deal on both fronts. You pay the taxes today and you pay the taxes tomorrow, but if they're only in the 401k for a limited period of time and then we roll them out to the Roth, that's where the benefits really come into play. So it's really just kind of like a holding bucket while we put the funds in there and then roll them out to the Roth, but you're going to need to have those type of funds allowed in your 401k plan, which is not allowed in all plans. And the reason that you need this is because if you're only contributing to, say, the pre-tax funds or the Roth funds, then across both of those buckets, you're limited in 2022 to $20,500 in total contributions. So you can contribute up to that much if you're not able to access after-tax funds, but if you can access after-tax funds, that's where you can get up to the full $61,000 amount. So that's provision number one. Provision number two is the ability to make in-service withdrawals. So we covered how to put money into the 401k, then to get the money out of the 401k, that's the in-service withdrawals. And this basically means that you can take money out while you still work for the company, because in a lot of cases with 401k plans, you're not actually allowed to distribute those funds without paying a penalty if you still work for that employer. If you leave the job, you can roll it into your IRA or your 401k or your next company, but an in-service withdrawal allows you to do that before you leave your company. Now, if you do happen to be self-employed, I've got a link at the top of the description below to the 401k plan that I personally use. It's called a solo 401k. And it basically allows you to do all of this stuff. It's the cheapest option out there. Trust me, I spent a lot of time researching this because I didn't want to have to switch down the line. So it's the cheapest option available to self-employed people. It's going to have both of these provisions and allow you to do this strategy. I've been using it to do this strategy for the last 2 years, so I can in fact verify that it does work. So this brings us to step 3. Now, depending on how old you are and how long you've been saving for retirement, this one could be a little bit challenging. So step 3 is to deal with any pre-tax retirement accounts that you currently have. So this is a very important step with very expensive consequences. And that's because to move money from your 401k into your Roth IRA, you need to ensure that you do not have any pre-tax retirement funds. The reason for this is that it triggers what is called the pro rata rule. It'll make you pay potentially a lot of taxes and severely complicate this entire situation. So if you have pre-tax retirement accounts, you can't really do this strategy. So you're going to have to get rid of them. And that's actually what I had to do personally the first time I wanted to run this strategy. So I had what is called a SEP IRA. It's a self-employed person's IRA. I know that's not actually what it stands for, but it's a type of IRA for self-employed people. I had about $15,000 in this account, and so what I had to do before I could run this strategy with the 401k and the Roth IRA is I had to roll that SEP IRA out into my Roth IRA and actually pay the taxes on it. Because if you're rolling from a pre-tax account into your Roth IRA, you're going to have to pay taxes on those funds. So in order to run this strategy effectively, you're going to have to roll out all of your pre-tax funds into your Roth IRA or other post-tax account. Now, again, like I said, this triggers tax consequences. So I had 15 grand in my SEP IRA. I rolled that out to my Roth IRA and I had to pay taxes on all of those funds. Wasn't super fun at the time, but if you are trying to contribute the maximum amount to your Roth IRA anyway, moving more money in there probably isn't a huge issue for you. The only place this could be a big issue is if, say, you're in your 40s, you've been contributing to a pre-tax account for the last couple decades, and you've got 6 or even 7 figures in there. It could be a very expensive tax bill to roll that out, and you might have to do it over a couple of years in order to just chunk away at that. So once you've gotten those pre-tax accounts out of the way, the next step is to actually contribute into your 401k. Now, this is where you take as much after-tax money as you want, up to that $61,000 limit, and you contribute it into your 401k following the provisions of your plan. Again, this is going to vary based on whether you're an employee, you're self-employed. I only know the rules of using the account that I personally use, so you'll have to make sure you're following all of the rules specific to your plan when you go through this step. One thing that is very important, though, is that you do not earn any interest or any growth on that money that you put into your 401k. You want this money to just be in your 401k very, very briefly before you then roll it out into your Roth IRA. The reason for this is because if the money grows while it's in your 401k, that's going to, again, really complicate your tax situation. You want to just put after-tax money into your 401k and then roll that same after-tax money, no growth, right into your Roth, because then there's not going to be any tax consequences of that, provided, again, you're following all the rules, you don't have any pre-tax accounts triggering that pro rata rule. If you're going by the books here, theoretically, there should not be any taxes due because you're just moving after-tax money into a Roth account. Again, not a tax advisor here though, folks. So if this is your first year doing this strategy, it's probably going to be worthwhile to talk to a professional. Now, to make sure that your 401k isn't experiencing any growth when you put money in there, just make sure that the default for funds when they go in there is just sitting in there in cash. Okay, you just want them to sit in there in cash, no interest earned. And so if you work for an employer, just make sure that all the deposits that go in there just sit in there as cash, and you shouldn't have any issues. And then if you're self-employed, use the account that I have recommended to you and the bank account that they recommend, because that bank account does not earn any interest. And so that is the personal setup that I have, and it has worked out very well for me thus far. Now, step 5 is to roll the money from your 401k out and into your Roth. Now, this step of the process can be a little bit scary. That's because a mistake here could be quite costly. Okay, we're moving tens of thousands of dollars. If there is even a slight tax slip up, we could be looking at a very, very hefty tax bill. So that's why I do recommend, if it's your first time doing this, seeking the advice of a professional is going to be a good investment. Okay, if you pay a tax person a couple $100 an hour to just look everything over for you and just advise you on this, it's probably going to be a pretty good ROI investment for you, just to make sure you don't mess anything up here. And personally, the first time I did this, I was on the phone with my Fidelity rep for probably well over an hour, just making sure I was doing everything correctly. I was just double checking on everything, making sure I did not do anything incorrectly here, because again, like I said, it can be very, very costly to kind of make an error at this stage of the process. But again, theoretically, if you're moving after tax money into your Roth account, there should not be any taxes due. That's because you've already paid taxes here. This is a post-tax account, so there should not theoretically be any taxes due, provided that everything has gone correctly thus far. And step 6, this is the fun part. You now get to invest the funds as you wish. So at this point, the funds have reached your Roth IRA. You have now contributed potentially up to $67,000 in a single year into your Roth IRA. And if you're a young person like I am, that can have insane impact, as it's allowed to compound over decades and decades before you do in fact retire. Again, this can be a very, very confusing process, but if you do have any questions, feel free to drop those in the comments below. I am not a professional, but what I cannot do is give you tax advice. Now, I'll leave my recommendation for a 401k plan at the top of the description below, and I'll see you in the next video.